So not only did we get a miss for the July number, we also had a downward revision to the June number as well. What does the breakdown look like in terms of sectors?
Well, this was a generally weak report across the board. The worst was information services, which is the tech world, and so that is not completely surprising. Government also hiring slowed significantly there, but there wasn't a particular area that stood out other than we like to look at temporary help services, and they lost almost 9,000 jobs in that area, which is sometimes a harbinger of worse things to come as companies cut back on temporary workers before they let go of their own.
Now, speaking of worse things to come, the other thing about the rise in the unemployment rate to 4.3% is that it triggered a recession call. And this has to do with something called the Sahm rule.
Claudia Sahm, a former Fed official, designed the rule, and basically it posits that if you get a certain level of unemployment, certain change in the amount of unemployment, when you get to that level, which is 0.5% above the low, then it goes up much faster, and you're already in recession at that point. And it's been a slow grind up as unemployment has risen. And while we didn't exactly get to the 0.5% move, it's close enough. And so that's why you're seeing the reaction that we have seen on Wall Street, is because everybody's afraid now that this portends really bad news for the overall economy.
So that's Wall Street's reaction. But I know you speak with Fed officials, you look at economist notes. What do Fed officials think of this latest jobs report?
Well, the first thing they're going to tell you is that we never look at one piece of data and make a decision based on that. And this is one data report. There'll be another jobs report, 2 CPI reports before we get to the next Fed meeting on September 18th. And so they're going to want to look at a lot of other different things. But it does appear clear that the economy is slowing. Now, you have to remember, that's what they wanted. They wanted the economy to slow down. The labor market was overheating. 114,000 jobs isn't a bad number. It's about the replacement level that the Fed would be expecting. It's just that we got there in 1 month rather than over a slow period of time. So they're going to push back on the panic aspect of it in the markets and say, we still have a strong economy. GDP has been strong, and we'll wait and see what the rest of the data tell us.
I guess they could also push back using another data point in today's report, which is the participation rate for prime-age Americans actually rose to the highest since 2001 to 84%. So that is a silver lining, isn't it?
It is a silver lining. It's something the Fed has been wanting to see. And really, the unemployment rate went up because a lot more people entered the labor force. People think they can get jobs. And so they start looking. And because that number gets larger, the denominator gets larger, it makes the unemployment rate a little bit bigger. One reason that even Claudia Sahm says the Sahm rule may not hold this time, because normally it's based on the idea of you're going into recession, so companies are cutting workers, but we're not really seeing that.
So that's an interesting point, the fact that the market will bring rates lower on its own. And you could see that with bonds rallying hard after the latest jobs report. Who does it not help out to have just market rates come down, but the Fed's key rate stay where it is?
Oh, it's not going to help the consumer borrowing as much. We know that credit card rates are very sticky, and that's what people notice the most about tight credit, is that they're paying more on a monthly basis for interest. It'll probably be slow to hit the housing market. Housing rates may come down some, but we're around 7% and have been for a couple of years. And we don't know how low mortgage rates have to go before people feel comfortable borrowing again, but some say 4 to 5%. So it'll take a while to get there. And then car sales are the other big interest rate sensitive sector. And again, we don't know whether companies will go back to offering incentives, something to drive purchases.